Pause for a moment and stay with me, because what just unfolded in the markets is not a headline you casually scroll past. This is a warning signal. Silver has crossed a line it had not touched in more than 4 decades, and it did so with a speed that forces serious people to stop and question their assumptions. In a single year, the price moved in a way that rarely happens without deeper consequences. And here is the detail that should make you pause in the right way. 1 ounce of silver is now priced higher than a full barrel of United States crude oil. Read that again, slowly. A small piece of metal you can hold in your hand now carries more market value than the resource that fuels trucks, airplanes, factories, and militaries across the globe. That is not trivia. That is not a coincidence. That is the market speaking clearly to those willing to listen. My name is Marcus Blackwell. I am not a financial advisor, but I observe financial systems the way historians observe fault lines, calmly, professionally, and without emotion. Patterns appear long before outcomes become obvious. And right now, silver is exposing stress inside the global economic structure that many people have been conditioned to overlook. My role is simple: to help you see what is happening clearly, without panic, without hype, and without illusion. Because once you understand why this is happening, much of the confusion surrounding the economy suddenly begins to make sense. For most of your life, oil represented power and control. Nations built foreign policy around it. Conflicts were justified by it. Entire economies rose and fell based on access to it. Silver existed in oil's shadow. Useful, yes, but rarely considered strategic. That hierarchy has now been challenged in real time, and the market did it quietly, without permission. When silver overtakes oil in value per unit, the signal is unmistakable. Abundance is being discounted. Scarcity is being repriced. And confidence in the monetary system that assigns value to everything else is slowly eroding. Part of this shift is directly tied to fragile supply chains, especially in politically unstable regions. Venezuela is a clear example. Over the past year, official acknowledgments from state authorities have pointed to ongoing infrastructure decay, power shortages, and a lack of foreign investment across mining and energy operations. Years of sanctions, capital controls, and centralized management have left extraction and refining capacity far below historical potential. While Venezuela is not currently a dominant silver exporter, its collapse reflects a broader pattern across Latin America, where underinvestment, social unrest, and regulatory uncertainty have constrained output in countries that once played a critical role in global silver supply. When several producing regions struggle at the same time, supply does not respond to price the way textbooks suggest. Mines cannot scale overnight. Permits stall. Capital hesitates. This is how scarcity becomes structural rather than temporary. And when markets sense that trust in both supply chains and currencies is weakening simultaneously, capital moves decisively. Silver trading above oil is not about metal versus energy. It is about a world reassessing what remains reliable when systems come under strain. The most revealing signal did not come from Wall Street analysts or policy briefings in Washington. It came quietly from China's manufacturing base. In recent weeks, several of China's largest solar producers disclosed plans to reduce or eliminate silver from future production lines. The reaction from financial media was predictable. Headlines framed it as a threat to silver demand. Some even suggested it marked the beginning of a collapse. That interpretation misses reality entirely. This is not a story of efficiency or technological victory. It is a response driven by pressure. Solar manufacturers operate on extremely thin margins in an industry already strained by overcapacity, falling panel prices, and relentless competition. As silver prices surged, what was once a manageable input became a destabilizing cost. Executives were forced to act, not because they wanted to innovate, but because maintaining the existing cost structure meant deeper losses and rising financial risk. Here is the distinction that matters. When buyers leave a market because they found something better, demand weakens. When buyers leave because they can no longer afford the product, scarcity is being confirmed. Markets are designed to ration limited resources through price. Rising prices push out marginal users first. especially those with alternatives and narrow margins. That is not dysfunction. That is how markets are supposed to work. What is unfolding now is a textbook response to scarcity under monetary pressure. When an asset sits at the intersection of constrained supply and rising demand for financial protection, price becomes the mechanism that forces adaptation. Silver is not behaving erratically. It is behaving predictably. Monetary demand is rising while mining output remains limited and politically exposed. When those forces collide, prices rise until only the most committed and essential buyers remain. The pullback by solar manufacturers must be viewed through that lens. It is not a judgment on silver's usefulness or performance. It is an admission that certain business models no longer function in a higher price environment. Industries built on razor-thin margins are always the first to adjust when input costs reprice sharply. That adjustment does not weaken the asset. It strengthens it. It confirms that the market is enforcing discipline. Historically, this phase does not appear at the end of a bull cycle, but somewhere in the middle. Early adopters accumulate quietly. Marginal users retreat. Skepticism remains widespread, yet the underlying pressures continue to build. This is the stage where narratives become confused because surface-level demand appears to soften while deeper demand intensifies. That contradiction only resolves at much higher prices, when the repricing becomes impossible to ignore. In a remarkably short period, silver moved from being a background line item in solar manufacturing budgets to one of the most destabilizing costs in the entire production chain. What was once manageable quietly became dominant, and industries built on thin margins could not absorb the shock. When cost structures shift that quickly, companies do not adapt calmly. They react under pressure. That is exactly what is happening across the Chinese solar sector. Years of aggressive expansion created massive overcapacity. Panel prices collapsed as manufacturers undercut each other simply to keep factories running. Profit disappeared. Financial disclosures from the largest producers show collective losses in the billions. These firms are not making confident, forward-looking bets. They are making survival decisions. At the same time, silver has become scarcer for reasons that go far beyond solar demand. One of the least discussed factors is geopolitical supply risk, particularly in South America. Venezuela, along with parts of Peru and Mexico, illustrates how instability, underinvestment, and infrastructure decay limit refined silver reaching global markets just as investment demand accelerates. When production falters and new supply fails to materialize, scarcity stops being cyclical and becomes embedded. This is the part most people miss, and it is where the real signal lives. Industrial buyers are not stepping back because silver lost relevance. They are stepping back because economics no longer works for them. Supply is tightening at the same time monetary demand is rising, and when those forces collide, the outcome is always the same: structural scarcity. Silver is also being rediscovered for what it has always been beneath its industrial role: a monetary metal. As confidence weakens in paper systems managed by institutions like the Federal Reserve and heavily indebted governments, capital naturally moves toward assets that exist outside balance sheets. This is not ideology. It is historical behavior. Silver responds to the same forces that once drove gold, but because its market is far smaller, the response is sharper and more volatile. When unstable producers fall offline and supply cannot respond, silver begins to change character. It trades less like an industrial input and more like a strategic reserve. Not because policymakers declared it so, but because the market did. The system is not breaking, it is recalibrating. And recalibration always feels uncomfortable to those still operating under assumptions built for a more stable world. When corporate leaders announce strategic pivots amid sustained losses and margin compression, it is rarely a celebration of progress. It is triage. These decisions are made to slow the bleeding, not to signal confidence. Replacing silver with copper sounds simple on paper, but in reality it introduces efficiency losses, durability concerns, and long-term reliability risks that do not show up immediately. Retooling production lines takes years, not quarters. And for companies already under financial stress, time is a luxury they no longer have. Here is the point most commentators still miss. Silver's price is no longer driven primarily by industrial consumption. It is driven by confidence. or more accurately, by the loss of it. Investors are not buying silver because of solar panels. They are buying silver because they are watching rising debt, persistent deficits, and declining purchasing power. And they are responding the way investors always have when trust weakens, by moving toward hard assets. Across the country, people over 40 are asking questions they have not asked in decades. How do I protect what I spent a lifetime building? What happens if the dollar weakens further? What assets endure periods like this? These questions do not appear at market peaks, they appear at turning points. Silver occupies a rare position. It is both a critical industrial input and a monetary metal with thousands of years of history. Long before modern technology, silver functioned as money. Its value never depended on innovation. Innovation only added demand. When currencies come under pressure, silver's monetary role reemerges whether policymakers acknowledge it or not. Now consider scale. The entire annual silver market is tiny compared to bonds, equities, or even gold. When even a small portion of institutional or household capital moves into silver, prices do not rise gradually. They accelerate. That is why industrial users are being forced out, not because demand vanished, but because investment demand arrived. China understands this dynamic. Their effort to reduce silver dependency is also strategic. In a fragmented world, supply chains matter. Reliance on external sources for critical materials becomes risky as geopolitical tensions rise. But technology cannot outrun markets forever. Innovation moves slowly. Prices adjust quickly. And right now, the price is winning. Every substitution announcement should be read carefully. Industries only redesign themselves when pressure becomes unbearable. That is not what market tops look like. That is what early-stage repricing looks like. Silver is not being abandoned. It is being acknowledged. As prices continue to rise, the pressure spreads beyond solar. Electronics, medical equipment, and defense systems all depend on silver for performance, where failure is not acceptable. These sectors cannot compromise or redesign overnight. They will pay the price demanded because the cost of failure exceeds the cost of the metal. When these buyers step in more aggressively, supply tightens further, volatility increases, and the conversation shifts from curiosity to urgency. Markets stop asking whether something matters and start asking how much they need. This is why preparation matters more than fear. Preparation means knowing where you are exposed and where you are protected. It means prioritizing purchasing power over speculation. Silver is not about chasing price. It is about preservation. It functions as insurance when financial structures are visibly strained. History shows that those who prepare early do not scramble later. If this perspective helped you see what is happening more clearly, stay connected. Follow this channel. Subscribe so you do not miss what comes next. These shifts do not reverse overnight, and understanding them early is an advantage most people never receive. And do not keep this to yourself. Share this with your family. Send it to a friend who feels the pressure but cannot explain it yet. These conversations matter. Silence is how people get caught unprepared. Leave a comment and tell me what you are seeing where you live. Rising prices, changing habits, quiet concern. Your experience adds context others need. When you understand the past, the future stops feeling chaotic. It becomes structured, predictable. And those who prepare early do not panic later. Stay observant, stay grounded, and stay ahead.